to give us a market cap if we want to pay for the company.
This is going to get ugly.
Before he even does the math, I'm just going to tell you that that's crazy to do it that way.
We want the 5-year PE ratio to be under 22.5. Remember, not the 1 year, the 5-year.
Good boy.
It is 196.
Wait, the 5-year PE ratio. What is the
That is an X.
Not
The
under-
one.
What is going on, guys? Nick here, back with another video. So on Monday, I put out my video about Nvidia and why I'm selling the stock, and I saw that Everything Money covered the same stock just this Thursday, so I thought it'd be interesting, since both of our channels are kind of similar, to take a look at their video and see some of the differences in the way that I looked at it versus them. So let's take a look.
I bring your normal person questions about Nvidia to a couple of wealthy guys who manage over $100 million in real estate, stocks, and bonds. And we'll talk about this chip maker right now. I present to you Paul Gabriel in all of his glory. Go ahead, Paul.
Hey guys, so first off, follow us on Instagram.
Yeah.
So guys, is our Everything Money software. We're going to go to the 8 pillars tool. We're going to type in Nvidia, and here is the data. Oh, look at this chart. Look at this 10-year chart. Oh my God.
The 10-year chart looks great.
The stock was selling for $4 in 2011. It's at $311 now.
Yeah, I love folks.
Well, it's not technically $4 back then because they did have a bunch of stock splits. I know the recent one was like a 5-to-1 split, so it definitely wasn't trading at $4, but either way.
If you're at home, see how this normal, beautiful little chart's just humming right along, and then bam, here comes COVID, and we're just exploding like 100x through the roof. So there you go, Paul.
So before anybody thinks that 20 years from now the stock couldn't be lower, let me remind everybody of Intel and Cisco. So Intel was the stock of 2000. It was the most amazing thing in the world. And look, we haven't even hit the 2000 number yet.
What's the market cap of Intel, by the way?
207 billion. Nvidia is 780
We
billion.
read an article, Paul, from early 2000 about how that was going to be a $1 trillion stock 20 years ago. It's never even gotten close.
Not even close. So guys, Nvidia, $776 billion company. Our very first pillar. We want the 5-year PE ratio to
They basically seem like they break their analysis down into a few different sections that they look at every single time, almost like a checklist. It's a little different from the way I do it. I don't really follow such a rigid approach. Mine's normally a little bit more free-flowing. I'm kind of looking at a lot of things.
We want the 5-year PE ratio to be under 22.5. Remember, not the 1 year, the 5-year.
Good boy.
It is 196.
Wait, the 5-year PE ratio. What is the
That is an X.
Not
The
under-
one.
Okay. What is the 5-year PE ratio? I don't understand how they're calculating this metric. It doesn't really make that much sense to me, because we can look at Nvidia's 5-year average, PE average, and we can see that it's never even been anywhere near 196. Right now it's at 108. Maybe what they're doing... Let's see. Hang on. But I just did some quick math to see if I could figure it out. So on the screen, you see these are the earnings per share. This is trailing 12 months, and then this is 2021, 2020, 2019. And the average earnings per share for them over this 5-year period is $1.70. And the current share price is 303.90, and that gives us a price to earnings of 178. So I think maybe what they're doing is they're averaging the earnings per share over the past 5 years, and then they're using that. Oh, God. So it's basically just the average earnings per share over the past 5 years, and then they're just comparing it to the price. So that's giving them a really high inflated number. A stock's average price to earnings ratio over the trailing 5-year period, it's calculated by adding the PE ratios of the companies for each fiscal year for the past 5 years and then divided by the sum of 5. And then on top of it, they're saying it has to be below 22.5. Honestly, guys, you're never going to find anything that's fairly valued if you do it like this. This doesn't make any sense. And if the entire market is overvalued for long periods of time, that probably means that your valuation metric is wrong rather than the market being wrong when we're talking about years and years and years. I think you're going to have a hard time finding stocks that are under a 5-year average earnings with a PE ratio of 22.5. This doesn't make any sense as a way to value something to me.
1-year PE is 110.
Yay.
Exactly. Pillar number 2, we want the return on invested capital over the last 5 years to be over 9%. Check mark. It's 14.8%. So this company does a great job of investing the capital.
Okay, so return on invested capital is a great metric, but it's more of a health metric rather than something that you use to value the stock. You want to see it well into the positive. Usually when it's negative, you have a company that's really starting to struggle here. It's a good early warning sign. Typically, though, I don't really focus on it very much because usually you can see a lot of other factors well before you end up seeing the negative return on capital. But kind of interesting, I did look at a couple other companies. So we can look at GameStop's return on invested capital. They've been negative since 2019, and we know their company hasn't been doing particularly well. We can look at GE here. This one's kind of interesting. So since 2017, it went negative. It also went negative, it looks like, in 2015. It came briefly positive in 2020, and now it's back in the negative again. So kind of hot and cold on that. Intel right here, which has been struggling recently, at least in terms of share price, but in terms of return on invested capital, it's actually pretty solidly in the positive. I think it's actually higher than Nvidia. Nvidia had like 14. Amazon right here, a little bit lower, 14, 11, 14, 13. It's positive, and I mean, that's fine. That's kind of what you're looking for. At least it's positive. Okay, this is crazy for Apple. 24, 30, 51. 51% return on invested capital. That is insane. Ford right here. So positive, and then negative. But interestingly, the stock price has basically been falling for all of these years until you start to see it in a negative trend. So that's kind of interesting to me. Again, I just look at this like a health metric rather than something that I really used a base evaluation off of. Yeah, right here we see Nvidia's actually 26, so that's actually pretty good.
5 years to be over 9%. Check mark. It's 14.8%. So this company does a great job of investing the capital.
Over 9%. That's good, I guess.
The business, making money off the capital that's been invested in the business. Now let's look at their dividend yield. Seth, what would you call this dividend yield?
Well, as Uncle Paul would tell us, it's just adorable.
Adorable. 0.1% dividend yield, $400 million. Now remember, guys, dividends aren't always safe.
Does Nvidia
in our
pay
software
a
right here,
dividend?
we make it easy for you.
Wait, does Nvidia pay a dividend? Yeah, so they do pay a dividend. Looks like the last one was about 4 cents. So personally, I'm far more interested in seeing the share price growth rather than a dividend. If the company wants to use that cash to continue to grow the business, that is perfectly fine with me. They do not need to pay me at all.
We put the free cash flow above to see the dividends actually safe. They pay out $400 million in dividends, and their 5-year average free cash flow is $4 billion. They pay out 10% of their free cash flow.
Yeah, so that's actually something that I think people sometimes don't always pay attention to when they're looking at dividends, is how well are they actually able to keep making these payments. In my opinion, usually you want to see, it's called a payout ratio. Usually want to see this at less than a third. Usually that's a pretty safe, good area. Right now it's at less than 10% of their capital being put out in dividends. So in my opinion, pretty good shape. Again, I don't care about dividends at all. They can keep all that money for themselves and just continue to grow the business, and that is perfectly fine with me.
In dividends, they Gucci. Pillar number 3, guys, we want to look at the income statement. We're going to look at revenue growth over the last 5 years. All we want to do is see growth. I don't care how much growth, I want to see some growth. 8.34 to 22.
That's some.
Now, I will say this, Seth. 8.34, 11.9, 10, 13, 21.9.
Yep.
What does that tell? Initially, that makes me go, remember, guys, I don't do research ahead. For all those people out there who claim that doing research about the company is important first, they're wrong. These numbers will tell me a story.
That's actually really true. To be perfectly honest, there's a lot of times where I'll look at companies just at their income statement first, and then I'll try to do some research into the company, learn a little bit more about them, and then usually I come back. Sometimes you start to see trends that otherwise you didn't notice when just looking at the income statement at first. So maybe you don't have to do the research ahead of time, but you still do need to do the research. You can't just only rely on the financials, in my opinion.
That I'll go look into. This is a big jump. Now, granted, chips have jumped up a lot last year, but I got to think there's been some sort of acquisitions along the way.
Yeah, the
So on the cash
Mellanox
flow statement,
acquisition.
you can look.
The Mellanox acquisition actually shows up right in there, and that, I think that's what drove a lot of that. But then you also had a slump between 2018 and 2019, and this is when Bitcoin and Ethereum had dropped, and because of that, Nvidia's sales dropped off. And I think that this is actually one of the problems that you run into by only looking at the numbers on paper. I see it right away. I'm going to put it right on the screen so you guys can see. I can see it right away that it's very apparent that the revenue dropped between 2018 and 2019, but they're kind of missing that here. He's just looking at this big jump and honing in on the fact that they made an acquisition, which is true. They bought Mellanox for about $7 or $8 billion. But I think they're missing out by only looking at it on paper.
Look at the acquisitions and dispositions and see if, because we want growth that's happening not just because of acquisitions, but still we have a check mark. Pillar number 4.
Profit growth over the past 5 years.
We just scroll down a little bit on our income statement. Got on a profit, net income, 2.3 to 7 billion.
Yikes.
Check mark there.
But look at before that, Paul.
It's beautiful.
2, 4, 3, 3,
Yep.
and then 7. Good Lord.
Guys, pillar number 5 is the silent killer, and one of the most important ones. It's our shares outstanding. We want to see shares outstanding decreasing. Now, I will say, with such an expensive stock, I don't blame them if they're issuing more shares, because what they're doing is they're the crack dealer on the corner who realizes everybody loves crack and doesn't realize how much it's hurting them. They don't realize, the Nvidia's sitting there going like, wait, all these people want our stock, even though it's massively expensive. Let's just give them what they want. So we scrolled to the bottom of the income statement. 2.39 billion, 2.49. That's an X, but it's exactly what I expected.
I mean, it's an X, but that's not that many more shares. You didn't get that much dilution. Yeah, it looks like doing the math, that comes out to about 4% dilution. And this doesn't necessarily mean that they're just giving out shares or issuing new shares. It could be situations where there's warrants being exercised that are dilutive towards the earnings per share. So I feel like we're kind of giving off a little bit of the wrong understanding. But anyways.
Guys, I'm actually surprised it's not higher, because why? If this company wants to raise capital, they shouldn't take on debt. They should issue crack to the addicted crack people on the streets.
Okay, but I think what we're really missing here is the fact that Nvidia doesn't really need to raise capital like that. Nvidia's profit margins are something like 30%, so they don't really need to raise capital by issuing new shares.
That's what they're doing here. So,
Or in their mansions.
or in their mansion. You're right. Well, cocaine's more of the mansion kind of drug. Let's be
By the
honest.
way, you have a little snow on your on your
I really thought there was
there.
something on my nose.
Pillar number 6, Paul, involves their debt, baby.
So, guys, debt's important in any company. We want to look at debt and say, can this company stick around if there's a recession? Just like you personally, the more debt you have, the less safe you're going to be in your financial future. Same thing with a company. So what do? We have our main page here. I go to the 5-year average free cash flow number. I multiply 4 billion times 5 for a total of $20 billion. I want the total long-term liabilities in this company to be under $20 billion. So how do I find that? I go to the balance sheet on our software right here. I scroll to the very, very bottom. Long-term liabilities, 13 billion. Check mark there.
Nice.
Great.
Pillar number 7 is free cash.
All right, so both of us agree that they're in a good debt situation. I do it a little different. I use debt to equity. Yeah, so they most recently reported, looks like $1 billion in short-term debt, about 11 billion in long-term debt. Shareholder equity is 21 billion. When I pull these numbers over into Google Sheets, that comes out to a debt to equity of 0.56. So to me, that's a great number. That's kind of the ideal number. Usually with like high margin tech companies, I pretty much expect no debt, and that's usually the situation. So basically what I would expect.
Cash flow growth. We want their free free cash growing. I'm certain it is, Paul, wouldn't you think?
I would imagine so as well. Free cash flow is cash from operations less your capital expenditures. You can use free cash flow to do one of 5 things: buy back shares, pay dividends, pay down debt, make acquisitions, and reinvest back in your company. Okay? This is the real true lifeblood of the company. So on the cash flow statement, I make it easy for everybody. I added this line right here, because cash from operations less your capital expenditures. 5 years ago, 1.94. Last year, 6.67. Check mark. Our final 8th
We're just
pillar.
looking for growth.
We take the average of the last 5 years free cash flow. We multiply it by a multiple of 20 as a starting point to give us a market cap if we want to pay for the company.
This is going to get ugly.
Very ugly.
Wait.
4 billion times 20
paying
is
20
$80 billion.
times this?
Final 8th pillar. We take the average of the last 5 years free cash flow. We multiply it by a multiple of 20 as a starting point to give us a market cap if we want to pay for the company.
This is going to get ugly.
Before he even does the math, I'm just going to tell you that that's crazy to do it that way. The reason why is because you pay higher multiples for companies that are growing faster. So, for example, a company that's growing at 0% per year compared with a company that's growing at 25% a year, if they both earn $1 today, the amount of money that those companies end up producing over the next 5 to 10 years is going to be completely different. And this is kind of what you're trying to estimate when you look at a price to earnings ratio. If you go back to my price to earnings mistakes videos, this is actually the number one thing that I talked about in this video. Now let's say I'm going to sell you one of 2 magic plants that grow money. Right now these plants are pretty young, so they only grow $1 and it takes a whole year for them to grow it. Well, one of these plants costs $15 and the other one costs $50. In other words, one of them has a price to earnings ratio of 15 and the other has a price to earnings ratio of 50. So which plant should you buy? Well, the one that costs 15 does seem like the better deal, right? I mean, they both only earn $1. Right now, we're missing some really important information. How quickly do we expect these plants to grow going forward? Now, what if I told you that while both of these plants grow $1 over a year, the $15 plant grows 3% more money each year, and the $50 plant grows 30% more money each year? Which plant do you now think is the better deal? Well, if we look at this chart showing how much money the magic plants will grow over the next 10 years, you can see the $50 plant has already started turning a profit, but the cheap $15 plant only grew $11, which is still a little over $3 short of what you paid for it. Now,
Very ugly. 4 billion times 20 is $80 billion. The company is 776. Massive X. Does this mean you don't buy the company? No.
Yes. Oh,
Well,
10x over.
the thing is, the company also grew their revenue by 50% 2 years in a row. So if you expect to pay a price to free cash flow of less than 20, you're never going to find companies that are valued properly, and this doesn't really seem like the appropriate metric to apply to Nvidia in their situation.
agree, but remember, guys, for other companies, a faster growing company should get a higher multiple.
Yes,
we put
this is what I've been
20
saying.
because we need to put something in our software.
Okay. It's kind of hilarious. So he put in 20 because it's something they need to put in their software. That's great, but why wouldn't we pick the appropriate number to put in our software rather than just pulling 20 out of who knows where and sticking that in? This is kind of crazy.
And guess what, guys? By the way, guess what? Really quick. Remember I talked about acquisitions on the cash flow statement? They made a $7 billion acquisition 2 years ago and 1.3. That's why their revenue jumped.
Yeah, that's what I was talking about with the Mellanox acquisition. And when I looked at it in the video, actually, I could just pull it back up and figure out what it was. Yeah, so the Mellanox acquisition added to the compute and networking area, and it was this jump to this jump. So 3.2 billion jumped up to 6.8 billion, so it was like $3.5 billion of revenue that it added to the company. And Nvidia explained that this jump was strictly because of the Mellanox acquisition. So it added $3 billion to their earnings.
You thought that was a lot of work before? We do the 8 pillars for you right here on the 8 pillars tab.
Well, that's
PE
nice.
ratio, and this doesn't bother me as much because they're just selling crack to people who love it.
Probably issuing warrants to their executives. Okay, so price to free cash flow. Like, this is just kind of a crazy way to look at things by taking the average of their earnings over the past 5 years. You'd want to rely on what their most recent earnings are rather than averaging the past 5, because if the company's showing growth, you're going to end up with a really low number every single time. You can't just use static numbers for these things. They have to move with the growth of the company. Sometimes you have companies that are showing no growth, and they're always going to show that they're undervalued when you use these metrics. And then you have companies that are growing really fast, and you're never going to buy into them because you're always pricing them as way too expensive. I would bet out of most of FANG that these guys must have been saying that all of these companies are way overrated. And if you had just bought FANG, I don't know, over the past 5 years and didn't buy anything else, you'd probably be destroying the S&P 500 in returns.
Massively overpriced, guys. Massively overpriced. The one thing
Okay, so we do agree here. It is dramatically overpriced. I just think that the way we got to this is completely different. Let me just pull up my value chart really quick so we can kind of see the difference. So mine is based off of looking at the forecasted earnings over the next 3 years and then multiplying it by the price to earnings ratios that I think the company is worth based off of their growth rate. And then it went back through to 2016 and I multiplied it by the same price to earnings ratios, and you can see here it's typically traded a little bit above what I actually thought the stock was worth. But then we can see over 2020, 2021 that the stock just kind of divorced from reality here, and I think that right now it is way overpriced. I wouldn't buy at this current price, and like I put out in my video, I actually sold all of my stock because I think it's a great price to sell at right now. I do expect it's going to come back down. I'm not sure exactly when, but we'll kind of see what happens going forward with it.
I do like, Seth, their free cash flow numbers and
Right in
multiples
line.
and earnings
Yeah.
are very similar. Mm-hmm. Okay, so this is
And this is probably because they don't have a lot of depreciation and amortization. So the net income and the free cash flow are probably pretty similar numbers. That's usually the only big difference between net income and free cash flow.
this is expensive stock. We're going to use our stock analyzer tool next to show what you should pay for the stock. It's going to be bad, guys.
If you see a lot of comments about Nvidia out there where people say, anything under 350 I'm buying or anything under 320, it seems arbitrary. What we'd like to show you the stock analyzer tool helps you determine, use assumptions moving forward for the future and see what we should be paying this to get a return. Paul will walk you through it right now.
So guys, the first thing I did was select analysis number of years, 7. Then I can pick number of assumptions. It's such a big company, I'm just doing 2. Now here's the deal, guys. We show all the numbers here that matter. Revenue growth, profit margin, free cash flow margin, PE, and desired return. I'm going to look at the 10-year, but remember, when you're doing this analysis, I'm not going to assume acquisitions. So a lot of this growth was because of acquisitions. So I'm actually going to go very low on my revenue growth numbers. I'm going to go 4 and 8%.
I think that's a little low.
Numbers.
Yeah, you're gonna.
Mo, what do you think?
You're gonna get killed.
Well, not necessarily.
No, in the comments.
Oh, well, yeah, if I'm going to get killed in the comments.
No, but
I know that feeling.
do agree with you. I mean, I looked through their acquisitions that they made recently. They acquire a lot of companies.
Yeah, and you can't include that as part of.
I think they showed earlier their acquisitions, and they acquired, it looks like 2 companies. One was Mellanox, I know, which was about $7 billion. They acquired something else for about $2 billion. I don't remember what that is off the top of my head. I think I looked it up in the last video I made in like January. The next big one is ARM, and again, that's going to be $40 billion coming down the pipeline. So we'll see if that one gets approved.
Growth.
That's the growth that we're seeing. A lot of the growth that we're seeing.
Yeah, I look at it saying if this company stopped acquiring, how would they grow? Because I'm buying that business.
Right.
Next thing is profit margin. Now, profit margin is probably going to stay pretty consistent.
Yeah, it should.
I'm still going to go 24 and 28%.
The way that they'll grow is continuing to expand their data center business. That's how they'll grow. It's actually growing at a pretty good rate. I think it was like up 27% between last year and this year, so it's not bad.
Free cash flow margin, I like to stay, if I can stay the exact same free cash flow and profit margin, I will. So I'm going to do that here. PE, this is where everybody's going to hate me. Guys, the PE and the free cash flow numbers are so different right now.
15 is like, that's a crazy number. It should not be that low. I ended up using a 22 to 35, and I just used my price to earnings calculator. Growth rate of 10 comes out to a fair PE of 22, and a growth rate of 15 comes out to a fair PE of 35. Now I'm kind of interested. They said 4, that gives me a PE of 12, and they said 8 for the top end. That gives me a PE of 18. So we're not that far. I'm a little bit lower on these growth rates than they are, but
you're going to be like, Paul, you're just being, guys, this is like saying, hey, you want to buy my house? It's $100 million. Oh, no? Okay, I'll sell it to you for $10 million. It's 90% discount. Therefore, it's a good deal. Well, if the house is only worth $1 million, $10 million is still too much, even if it's 90% reduction in the price.
okay, that's not really what this is. The problem is that they've stuck to such a rigid low earnings multiple. And now, again, I agree with them. The stock is overpriced. I just don't agree with the valuation that they came up with. Using just 20 and 22 and a half as a static earnings multiple, no matter what, is kind of like saying that at my employment, I'm going to pay all my employees the exact same, when there's some employees that earn a lot more and are worth investing a little more capital in, and there's some that aren't very good, and you either fire them or you don't give them very good raises.
Same thing here. This is just priced really, really high. Over long periods of time, this is not going to be a 100 times PE company. The bigger the company, the slower the growth, the less PE should be there. Okay? Do you agree with me?
I mean, Amazon is like double their market cap. They're growing at like 20-25%. And they've maintained that high multiple for a pretty long time. So you can't just always assume that.
I don't know. You probably don't. You're going to get comments below saying, this guy has no idea what I'm talking about. Just turn the video off. I don't want to hear your comments. I don't want to hear your comments.
I think that's reasonable.
I'm too busy flirting with your mom on Snapchat as she slides into my DMs
Yes.
and sends me pictures of her. Just go away.
Ugh, cringy.
I don't want to hear from you.
Okay.
I hit the analyze button. 311 is the current stock price. Any guesses here, folks?
Slides into your DMs.
Well, close to $100 a share.
Oh, I think it's lower than that.
Oh no, where are we at? 80?
I'm going to say
80 to
40
100?
to 50, $40 to $60 a share.
All right, do it.
Let's see.
Oh,
What does it say?
30 to 50.
Oh, okay.
I mean, you're never going to buy this company at this price. And I get that their point is to say that this is the only price that I would buy it at. I was reading a Reddit post the other day, and it was like somebody going through Martin Shkreli's like philosophies, and one thing that he said that I thought really stuck out is, if everything that you're valuing comes in as way overvalued, then your valuation metric is wrong. 8 out of 10 companies should be fairly valued. Now, obviously, there's times where there's market bubbles, and there's a lot of people who clamor that right now is a market bubble. I absolutely disagree with them. But I just think that this is a crazy way to value this company, and it's just not really a very realistic look into the way that they're doing it, especially by using these like 5-year earnings averages or free cash flow averages. That just doesn't make any sense to me.
Okay. And by the way, based on that PE, it makes sense because the PE has to fall by 85%.
Yeah.
Stock has to fall by 85%. 15% of 311 is $47.
Okay, but the other also really important thing that they're missing out on is, where is the company going to be in just a couple of years? Because we could have a company that, let's say they're earning $1 this year, but something crazy is going to happen and they're going to earn $5 next year, right? There's a lot of people who are going to start to price that future jump into the stock today. They're not going to wait until it earns $5. And because we're only looking backwards, we're only looking at today and backwards, we're going to miss out on some really good opportunities. Something that I used to use the Yahoo Finance Portfolio Watcher app all the time, and I think what really sparked my idea about this is I could see the forward price to earnings ratio, and I kind of realized that, hey, I think the company is worth, I don't know, a price to earnings ratio of 20 today, but based off of its earnings that it's expected by next year, it's only at a price to earnings of 15. So maybe I should just stick with the stock, and of course, if I just wait, the price has to go up, and we're just completely missing that here.
Let me translate some of this gibberish. If you buy at 300 and they keep doing what they're doing with these assumptions, you're not going to make much money, but you have to buy at $50 to get that return. So you don't have to buy this, Paul, but show them some of the, what should you be paying? What
Never going to buy the stock at $50. That's just crazy.
can you expect if
So
you
let's
pay
do
today?
this. If we put 0% return, we want to make no money. The stock is still only worth between 60 and $100. That means in 10 years, they think it's going to be worth, the stock on the high side should be $100, low side 60. What if you want to lose money?
That's actually a lot closer to where I had valued them. So again, look at my valuation. I have by 2024, I think the stock will be worth about 117 to 178. The midpoint is 174. So actually, based off of the trailing earnings, I'm not that far away. The low end number I have for them is 64. The top end is 98. But the thing is like I was saying before, you have to look into the future, because we can see right here, the stock's going to continue to grow. If the stock was trading at maybe 120, you wouldn't necessarily say that the stock is way overvalued, right? Even though, potentially it could fall by, a little under 20% all the way back to 98. But because we know that the earnings are going to continue to climb in the future, we know that there's enough upside for us to buy at 120 if that were to be the share price.
Negative 5%.
That's nice. It's just math.
Okay. So guys, based on this number right now and my assumptions, I'm going to go to losing 15%. Still not there yet. So guys, if you buy this company, and guess what? You might sit there and say, well, Paul, your assumptions are wrong. Okay, let's go back to 12.5%.
Put the revenue at something.
Let's go to 15 and 20% revenue growth.
Perfect.
Okay, so this is a little higher than what I had.
15 and 20% revenue growth. It's still an insanely overpriced company.
15 to 20%. So I can actually compare my numbers directly. So 15 PE comes out to 35, and a 20% PE comes out to 54. So 35 to 54. All right, so looking back down. So according to my numbers, based off of the 2022 trailing 12 months, that puts the low end valuation at 98, the top end at 151. And that will put by 2024, it's not, it's a little overvalued. I mean, it's overvalued for sure at this price still. But it's not as crazy as a valuation as what we currently see. And their numbers are 98 and 52, so they're significantly lower than what I have right now.
Company. And you're going to argue with me about that PE. Just like that idiot in California who ran for governor who said Tesla's PE is the largest company in the world with $3 trillion in revenue should be 70. You're just going to lose a lot of money.
Put in a 30 and 40 PE, see what it does. Because
I'll one-up you. I'm going to go 40 and 60.
Okay. Yeah, 60 PE. This is
Let's
the
see.
new. This is the new day, Paul.
60 is too high.
There you go.
Oh boy.
Ain't nobody got time
If
for
this
that.
makes sense to you guys,
Yeah,
you should.
but the problem is right here we're only looking at trailing earnings, right? We're not looking at a couple years. Let's just say, for example, the company was worth a 60 PE. Let me just type that in really quick. Now, excuse me why I don't reformat my chart, but a 60 PE would put the company by 2024 at 305. It's still overvalued, but this isn't quite as crazy. We can see that the earnings eventually do catch up to it. But obviously it's too high still. But this is kind of what they're missing by only looking at trailings. When you only look at the number here, you kind of ignore this growth. This could sneak up a lot faster if they have, a whole bunch of headwinds coming for them over the next couple of years.
To join our community. If it doesn't make sense to you, you should take your money out into a can and burn it because you have no idea what numbers are. It's just math, guys. Every
just
investment's a
math.
present value, future cash flow. Now, the good news is Mo does charts. Doesn't matter what the fundamentals are. All you're looking at is the charts and the
True.
movements of the stock. Mo, show everybody if it's going to work.
I always think it's funny. People call technical analysis astrology for men.
Take it away.
It's
So
hilarious.
right now, this company has had an incredible run up in the past couple of weeks,
Yep.
last month, because of everything that's happening with themselves and with them joining on to Meta. So this to me is a flagpole, and I'm gonna really zoom in here and show you even more so than the flagpole. If you look at this flagpole pattern, you have these wicks that just keep happening even today. This indicates to me that this thing is coming right back down to where it came from, and I think that level is around the 260.
I think what would be helpful here is to also pull up the volume chart and see if volume is declining as we kind of get higher and higher. If there's less momentum, less people joining in to buy the stock, that's kind of a good indication that the stock is kind of at the top. I don't really know why he doesn't pull it up here. One thing I will say, though, about technical analysis is it's a little bit of a guessing game. It's not really as exact as a lot of people try to make out to be. Don't ever think that anybody can guarantee what's going to happen next by only using technical analysis. That's kind of impossible.
What is this? Oh, 230. What I would rather tell you to do, instead of doing this from a long-term perspective, look at it from a swing trading perspective. So this is a day-to-day chart where you can go and make money and catch different trends. You could have caught all of this run and known you're getting to a point with declining volume, you're about to roll over.
there's
here,
the volume.
and this is probably when you start taking your profits. And if you want to, learn how to short it all the way back down to that 220, 230 level. So this is what you need to do on a company like this to make money. You can make money going long and short on a company like Nvidia. You don't need to sit in it for multiple years and just hope to God that it goes up, because more likely than not, it probably won't based on its fundamentals. So charts are where it's at if you're trading a crazy company like this.
If you're drawn to this and this resonates and you want to be a value investor, stay away from Nvidia at the moment. The chart is obvious. If you want to trade it, you can get after it with Mo. Fondle thumbs up. Thanks for joining us. We'll see you next video.
All right, and for using the video, I'll give them a good little thumbs up. So pretty interesting video. My biggest hang up is the fact that, one, they use an average of the earnings over the past 5 years. I think that's always going to start you at the wrong spot for valuing a company. You should be looking at the most recent trailing earnings. It just doesn't make sense when companies grow to go back a couple years and value them based off of what they made a couple years ago. The other thing, again, is using really static earnings multiples. Just sticking at 20 and 22.5%, it just doesn't make any sense. You have to account for the company's growth. It seems like they did that towards the end. And then the last thing I would say is they still need to look at the forward earnings of the company. They can't just look at the trailing. Otherwise, you're going to miss out on a lot of opportunities, in my opinion. But otherwise, pretty interesting video. We both came up with the same conclusion that the company is very overvalued. We just ended up going about getting there in completely different ways. So that's the video. If you liked it, make sure you check out this good video I have up here next. And as always, thanks for watching.